We're going to go through chapter 10 and problem 10, 10 handout, excuse me, 10 handout and the chapter 10-33 problem. And then I'm going to email it out tomorrow. This is going to be the last thing we do. We're off next week. So this will be our last week. Not next week, the week after, the week of is it the 11th? Give me one second. Yeah, so on the 11th, I'll be online and in class. Everything I usually leave that open as a kind of a cleanup, but everything has to be in by the 14th. And I'll be giving you guys the exam tomorrow. It might be tonight, but more likely tomorrow. And it'll be due on the 14th, so I'll give you a couple weeks to turn that in. Anyway, that'll be it. Yeah. Any questions? All right, let's go through. Okay, so we're going to finish up the chapter 10 handout. We're going to do the temporal method, and then we're going to do a problem, and that'll be it. Okay, let's see. Problem 2. Yeah, functional currency. Okay, so functional currency is US dollars. So that'll be this will be the temporal method. Yeah. Okay, so I'm going to go ahead and copy this. The temporal method. And this one is a little bit more complex than the other one. And it's a little more complex because it basically is everything's getting wrapped up. In the future, I should just have these inside here. Okay, so here. I'm just moving this up. For whatever reason, the book has the income statement on the bottom. I should probably just ignore that and put it up on top. Okay, so temporal method. Start out pretty much everything is the same here. You'll see that this is kind of all similar, what we've been doing. And what we're going to do now is kind of move things over. Now, the income statement is going to be not too bad. It's going to be, everything's going to mostly go in at average cost. That is still, the usual for it. So let's go ahead and get started on that. Average cost, this. Wait a minute, I did something wrong here already. Right here. Cost of goods sold is going to be at a historical cost. Now, okay, here we go. Inventory historical. Yeah, I goofed up already. What's wrong with me? Okay, let's see. We'll make that orange. Okay, So inventory can go in at historical cost. Multiply these out, how about? Okay. Operating expenses without depreciation, that'll just be at the most expenses, will be average cost. What's a better way to do this? All right, so this be depreciation expense. Historical, now this is gonna be a different historical though. This is gonna be the historical for the property, plant and equipment. So let me change that. So the historical for property, plant and equipment is going to be from the beginning up here. Oh, yeah. Yeah, so the 225 down here, this will be at the historical from the beginning. So this is the historical we're gonna be talking about. $130. Gain on sale of equipment. Yeah. Oh, at 430. Okay, so this is a specific one. Purple. Yeah, we're actually gonna add something else up here in a little bit, but this is gonna be what we'll have right now for a net income. Okay. So our net income is that. Beginning retained earnings, we'll go back to the historical from the beginning, which is 130. Dividends were paid on 9/1. 9/1 is that. Green, 126. By the way, if I put anything up here wrong, make sure you say something. All right, let's see. I gotta do something about the sound here. I can't have Windows telling me whenever I do something wrong. Okay. All right, so here we go. So this will be adding these up. So there's the ending retained earnings. Okay. Cash and receivables, those go on at the current rate, which is the ending rate. Oops. Receivables will be on at the same. Inventory is going to go on at the historic rate, which we already used up here for the cost of goods sold, which is 123. Orange. Hey, I'm not multiplying these out. What am I doing here? Property, plant, and equipment goes on at the historical rate from the beginning. That. Okay, so that's our balance sheet. Now we go to our um, liabilities. And liabilities virtually always go on at the ending rate, which they call the current rate. I guess current for the year-end rate. Maybe is a better way to put it. Common stock goes on at the same beginning historic rate as we had before. Retained earnings is going to be the same number as this composite. So you guys are waiting for that all confusing arrow. Starts out as invisible light blue. Okay, so that's the 28175. So we add them all up. And we are going to get a difference of 15,375. So there's going to be a loss. Okay, so let me show you how this would actually be shown though on the financial statements. This translation gain or loss would actually be on the income statement. So this negative 15,375, negative 15,375 would be shown right here. Oh, I'm sorry. You don't have the automatic, and I gotta redo this. You'll see this come down here. So this loss will actually be shown right in the income statement. It's taken off as a regular loss because this money is being converted directly into US dollars. It's completing the cycle. And this loss will just be in there as a line that we lost this much money on it. Or gain, depending on whatever it was, but it'll be shown right in the income statement. Whereas the other ones, these will actually be shown in the balance sheet. This would look something like this if we were to actually. So this is what is this, number one? Number one would look like this. Actually, this would be called this would most likely be called a comprehensive. Five five zero. So that's where this would be shown. It would not be in the income statement. And the reason why that would not be shown is that money has not reappeared it's not in US dollars. It hasn't completed the cycle of coming home, shall we say. So it'll be sitting there and it could go up or down, year to year, and it'll just sit there. Whereas this one is taken out of the income. It's as if we lost that much money, if that much cash just went out the door. Any question on that? Get it before I did that. Yeah, so this is the temporal method, and the temporal method is kind of considered to be when it's in US dollars is so interlinked in our cash flows that we take the cash directly into our US accounts. And that's why these are actual gains and losses in here. Whereas down here, these are just kind of, this isn't like it's cash going out down here or coming in. It's more like an adjustment for the different values of the currency, but it's not necessarily any permanent difference. All right. So this is the temporal method. And this would be used a lot of times if you're dealing in a country that maybe has a very high rate of inflation. If they have a high rate of inflation, you want to get the dollar or whatever currency they have into US dollars quickly because US dollars are more stable, or it could be some other currency too. You could go into, euros or whatever currency you think is more stable. But if they go into US dollars, then we use a temporal method. Okay, let's go to problem four. And I'm gonna copy this mess over here. F18, let's go to F18. Nope. Yep. Ah. Okay. And the fun starts all over again. All right, so we start out again with average cost on this one for the revenues. Yeah, let's keep all the festive colors the same. I get my eyes fixed tomorrow, or I get the injections in them. Anyways, I'll be able to see things and read things and write things. All right, let's see, format cells. Hold on, change that to. Okay, cost of goods sold, that's inventory historical. And that's kind of an orange, kind of a peachy color. Let's call it peachy. It sounds better if it's peachy. And this one you'll notice is this income statement is a composite right away. You know, it's two different exchange rates. Normal operating expenses are going to be just at the average, you know, lighting and all that kind of stuff you pay throughout the years. Electricity, rent, blah, blah, blah. You get the idea. Depreciation expense will be at the historical, however, it'll be at the historical for the equipment, which will be from the beginning of the year. By the way, if you're wondering where I got this is similar to a problem that we had. Gain on sale on land on 622. 622. By the way, just so you know what you're missing here, it's freezing in this room again. Last week, I was just in a room earlier today, it was roasting. No. We have weather systems in our rooms here. Okay, so this would be that. I'm gonna do something here. I'm gonna insert right here for our translation. And just so we know that it's coming, that it'll be here. Um, yeah. And again, this one, because it's temporal method, it's right into, it goes right into our cash as if we lost that cash or gained that cash, depending on what it is. Okay, let's see, beginning retained earnings. So this is historical. That should always be historical, in case it's the beginning of the year. Net income is just this net income. There is no. And there really isn't a rate for it. It would be a composite if you know. It's all these. There is no one rate for it, so. Okay, dividends declared is not a composite. They were declared at one time on 10/31 on Halloween. Nope. Yep. And that's just a coincidence that it's the same as the inventory historical there. Let me give that a color. Okay, coming down here, cash will mostly be year end, what they call the current rate, the year end rate. Give that a color. Red. And this will be the same. So at year end, what are the values of these things you're gonna collect? You got the cash, what is that worth at year end? You got your receivables, what are those worth? Inventory goes on at the historical rate, which is 129. Property, plant, and equipment goes on at the other historical rate, the beginning historical rate, which is 133. $1,028,400. Question on that? So this way is a little bit more, you gotta go right back to kind of where they were at, to start out with. And the reason being is that these are actually in US dollars. So where it was, it makes a difference. It isn't like all this is being kept in the foreign currency, it's being in US dollars. So these that would normally be at year end rates, they're as if they're in US dollars, so we have to go back to the whatever they were at the time, the historical amounts. Okay. Liabilities are virtually always a year-end amounts. Common stock, beginning of the year, which is the historical, it could go back 5 years or 10 years or 20 years. Retained earnings is this retained earnings up here. We do not calculate it again. It's the same retained earnings. What we do is we take our arrow from this one and put it over here. That saves the arrow adjustment, the all comes the arrow adjustment for the retained earnings. Being brought down here. Wow, this one's pretty close. That's almost freaky close. It's only off by 120. All right, well, that would be let's see, we have more assets than things we owe, so that's a gain. Now I gotta update this. Oh, let's try to update that correctly instead. How about? There we go. So this will be the translation gain. Uh, Not material really, but yeah, so that's what it would be. It'd be shown right in the on the income statement. All right, any question on that? Okay, but by the way, there's kind of a funny anecdote that I had a friend who he did auditing a long time ago, like when it was done by hand, pretty much all the journal entries and all, especially all the big stuff was done by hand. The run of the mill stuff was done on computers, like big mainframes, but anyway, it was kind of like this situation where they had a small, a small translation gain or loss coming in. And there was some kind of an error when they had these overseas operations and there was some kind of an error and it came out that it was off by a couple $1,000s. And, they're talking about like, million billion dollar companies. And it came off that it was off. And, the controller did not want to restate the income. And he said, no, we're not going to do that. But also he knew that like if you didn't do something with it, with the bank reconciliation wasn't going to come out right. So he, he made a journal entry that only had a debit. It wasn't, accounting 101, you have debits and credits. And it bugged my friend to no end that you see this journal entry that just had one side. It had a debit. And then later on, the next year, they put in the credit for it. But yeah, it had to do with the translation gain or loss. And again, it was completely immaterial. It wouldn't matter. The CPA firm signed off on it, but he said it just bugged him to see that journal entry with just one side on it. And then the next year they had a journal entry with just just the credit for the income on it. All right. Any questions? All right, well, let's do the problems. We'll rather, we'll be able to get through this a little early. Let's see here. Oh, it scared me for a second there. I didn't think it was gonna come up. Okay, I think this is the problem that I kind of built the one that we just did off of. I changed a few things on it. I changed these on it. I changed a couple of things on it. You're probably thinking, well, that's probably gonna be messed up. So, in the book, they showed it the current method, but I want to do both the current and the temporal method. Just to, just so you know, and the CPA exam, you never know what they're gonna do. They could have either one. The current method is often used by companies that, well, if they don't bring the the dollars back to the United States, change them into US dollars. And there's a number of reasons why they do that. Sometimes it's a completely separate operation. They just want to keep it separate. They want to keep, they don't want to have it all based on the US market. There's also, I think I mentioned this before, that different countries will have different tax rates. And in some countries, you can negotiate tax rates based on your company. And that's not unusual in the US either at the local level, at the state level and all that. But I think I told you guys this, that Apple had negotiated to pay zero taxes on their income for all the European operations that went, and they made that deal with Ireland. And the problem with it is you get all this cash in foreign currency that was all in euros. And if you want to bring that to the United States is going to tax it. And they'll tax it on the difference. So for example, if a country charged 12% tax and the US tax was 20%, the extra 8% would be taxed when that money is brought back to the United States. So when you bring the cash back, exchange it into cash, bring it in the United States, you'd have to pay 8% on it. Now, Apple didn't pay any tax on it. So they have to pay full US taxes bringing it back in. And there was some discussion about whether they were gonna allow. Now, you want to have investment in the United States, so you kind of want to have that money back in, but at the same time, the law, the rules are that if you bring it back in, you're gonna get taxed on it. And in this case, it would have been taxed at the entire US tax rate. So anyway, sometimes they'll keep it in the other country because it'll actually be worth more in the other country because you won't be reduced by the taxes. So there are reasons why they sometimes won't have them. They won't bring it back into the United States. Could be they just want to keep it separate, separate economies, spread out the wealth and the risk and everything else. It could also be for taxes. Okay, so let's jump in here. Sales, these are going to be done at the average rate. There, 159. Excuse me. Cost of goods sold. We're at the current method. Let's bring up the current method just for kicks here. We got the temporal method. And you'll notice something very similar about it. Pretty much everything on that is going to be the income statement. Everything's going to be at the average cost. There are some things, I think we'll have a gain or loss here that's at a specific date. The gain on sale of equipment, we'll look at that one. Okay, but everything else here is going to go in at the average. And this is for the current method. Hey. This one you could actually do the exchange rate for the gross profit. Technically, it's not a composite, it's at the same rate. And everything else here goes in at the same rate, even depreciation goes in at the same. Oops. Gain on sale of equipment. The gain on sale of the equipment was sold on September 1st. Let's give that a color. How about? Did the order of this thing change? It was, and the last one we did was orange. All right, the one, I'll put this one on the right. Okay, so let's take a look here. So this is on September 1st. My eyes are all wickety whack. I can hardly see this thing. Okay. And so this would be our gain. We're going to do auto summit. Now remember, this is only coming from here down. So 114, 190. Okay, this will come down here too. I know what you guys are thinking. We want to see more arrows. Those arrows are so cool. Okay, okay, okay. All right. All right. Go to retained earnings, the historical rate. This will be historical. It says composite. Originally, it's going to be a historical. At the end, it'll be composite. At the beginning, the very first year, it'll be historical. The first line. Where am I? So it is January 1st. Oh, we got to give that a color. Kind of purpley blue. Dividends paid on April 1st. That needs a color. One six one. And now we add this up. Okay, now you'll notice that this up here is a composite. So it's a composite here, it's going to composite here. And a composite there. Hey, wait a minute, I didn't do something here. 161. You know, it's got all different rates. It's got 159, 172, 167. So there is no one rate for that, but this will be the ending. Oops. Of it. So when it's my point being, when you come down here, when you see that the retained earning is a composite, that's because it's you know, at the end of the year, it'll be a composite because all these will be composites going into it. Be all different. Okay, let's go to, oops. Assets. you'll notice something very, well, nice. If you like simple calculations, everything goes in at the current rate, which is just the year-end rate. So the year-end rate is that. Let's give the year-end rate a color. I don't even know what that, oh, it's gray. All right, well, sorry, year-end, you gotta be gray. Just get a better color for you, but that's the way it goes. I need to copy down my grayness. There we go. It's all gray. Actually, this would probably not be. Well, technically, there's nothing wrong with it. It's not. It is not a composite. Uh, yeah, it'd be the same. You could do it. There's nothing wrong with doing it that way. Okay, so down here, retained earnings will be, well, that'll be right from what we had up here. And we're gonna add it up without the translation, adjustment. All right, this one, minus. So the translation adjustment here, and again, this is notice that this is in the balance sheet. This is not on the income statement. So this would be a translation adjustment, probably called a comprehensive. Oops. Translation adjustment would be 31, a negative would be a loss. Negative 31, comma, 110. So that would be shown as a line item on the balance sheet. And again, if this could go up or down in any given year. There is something a little bit interesting up here. Really spaced out. Oh, I did this wrong. Everybody, new plan. I did this wrong. I didn't realize something here. This is important. The retained earnings should be this. This is a given. All right, I gotta make a change here. I apologize. Okay, so this is important. We gotta change this to this. This is this actually is a composite beginning. So everyone do me this favor, change this one. And this will change it down here too. Um, Our loss now is negative 66910. I'm glad I looked at that. Okay, so our translation adjustment, they tell us this is a debit. This is almost like a CPA question would kind of have. A debit on the for down here for these in the on the balance sheet, the liabilities and all this stuff, they go up with credits. So this loss of 66,910 comparing with a loss of 85 the previous year. The current loss is 66,910. Excuse me, I couldn't mute the thing fast enough. Okay, let me do it. So 66,910. Now, these are cumulative. So if we had a cumulative loss last year of 85,000 and we have a cumulative loss this year of 66,910, what does that mean overall? So our running total loss was 85,000. Now our running total loss is 66,910. So if that's the cumulative total, if the cumulative total, if the cumulative loss goes down, what does that tell you? You know, if you were in the hole, let's say 85,000, and now you're in the hole 66,000. Well, let's see what the difference is here. What would that tell you?
It's about 18,000, $18,090.
Yeah. And that would actually, if you think about it, that would actually be a gain overall. You know, it's sort of like you made back $18,090 of it. So the difference between those two would actually be that, you know, a better off it'd be a gain. Now, it'll still be shown down here like it is to make it balance, that it's a loss of 66,910. But if there was a comprehensive part of the income, this is not a this is not, this is a net income statement. This isn't comprehensive income statement. My comprehensive income statement would show that as a gain of $18,090 because it's actually reduced the loss from one year to the next. This comprehensive gain, I tell you, you know, this comprehensive gain and loss for a long time, United States was the only one that did it. And I was like, oh, I can't wait till they combine to get rid of that thing. When they combine, you know, they started having the international standards try to combine with the US standards, instead of the US getting rid of it, the international standards adopted it. Now the international standards have like, don't. I hate that thing, you know, it's confusing. People don't know what it is. People don't know why, you know, is it income? Is it not income? Um, the only people that know the difference are accountants. But anyway, yeah, so the comprehensive adjustment will be a loss on the comprehensive income, it would be shown as a gain of 18,000. And again, this is not a comprehensive income statement. This is it's a plain old income statement. So it doesn't show up at all. Okay. Let's go to the temporal method. What time is it? Do you guys want to take a break before you do this one? Or do you just want to push through?
Yes, we can push through if everyone agrees.
Yeah, go for it.
Okay, very good. Let's do that. That's the last class. Come on, everybody. All right. So this one's gonna be a little bit more involved. Before I do anything, I'm gonna put in the I'm gonna put the retained earnings in because once bitten, twice shy. I don't want to make that same mistake again. I think I put it in as that. And then I can just relax and go through here like we normally would. Okay, so by the way, here's a difference. You notice we had the translation adjustment from the previous year on this one. We can figure out what would be the comprehensive income impact of it. There isn't one on this one because they didn't have a translation gain or loss. It's just a plain old gain or loss on the income statement. So you're gonna have foreign currency, you're gonna have this here. Foreign currency gain or loss is just gonna be recorded and done. Gain or loss, it'll be whatever it is, and that'll be it for the year. Okay, so let's go to sales. Sales will go on the temporal method. What happened here? I'm missing half of my. Oh, look what I did. No, I got a bunch of stuff hidden. I bet you money I got some calcs in here. Now I want to see what it is. Oh, look at all that. Huh. Why would I have that down there like that? Is that necessary? I don't think it is. You got a translation adjustment from 2016. Let's get rid of all those. All right. Coming down here, we have most stuff goes in at average. Cost of goods sold will be at historical cost for inventory. Depreciation will be at historical cost for property, plant, and equipment. So I have to pay attention to those two. I don't think we have any amortization expenses. Nope. Okay. All right. So let's go through this. Exchange rate is average for sales. It is so cold in this room. I'm gonna start breaking up furniture instead of getting on fire. Uh-oh. Okay, so that will go in at the weighted average. Cost of goods sold will go in at inventory historical average. So historical average. Okay, so they're using historical ones, but they're doing average. Are these colors too dark? Can you guys see them?
No, they're fine. Mhm.
Okay. It's kind of funny because on my screen, they look really dark, but on the projector over here, they look, okay. Okay, and this one is going to be a composite right away. First line is a composite. These two are different. Okay, depreciation expense, scratch that, operating expenses without depreciation. So these will just go on at average. Things like rent, you pay rent every month, is gonna be averaged throughout the year. You pay, electrical bills and all that kind of stuff. Depreciation expense. Now this is way over here. Exchange rate when, no, okay, this is the exchange rate when the equipment was acquired. It was 2. They don't look like the same, but, all right, so it's a historical, it's just a different historical. Gain on sale of equipment. That's the same as we had before, sale of equipment. September 1st. I did that wrong. Where am I at here? Let's try that again. Okay, and we'll come up with a kind of a preliminary income. We'll figure out what the gain or loss on the currency exchange is in a little bit, but we'll call it I gotta get this out of there. This is wrong. Okay, so net income is just gonna be this. I'm gonna show you guys how to be lazy like me. Copy my little arrow over here. See how lazy that was? All right. Dividends were paid on April 1st. Uh-oh, I made my dividends the same as this thing. Be easier just to change that to something. All right, so this will be. Um, Cash is gonna be at year end and receivables will be at the year end rate, the current rate, and that's why they get this. Um, the name for this from. We're running out of colors. How'd that happen? I don't think we didn't use, is this purple? No, it's gray. Where's purple? Blue. Blue, gray. Light gray. What happened to purple?
Part of the standard colors
Yeah.
down there. Yeah,
People look sort of like gray too.
yeah, that's a part of the standard colors.
Let's see here. Yeah. That's good. Okay, we can't see that. Oh, I don't know. We'll use that. Yeah. Hardest part about accounting is getting the right colors. All right, so we have, let's see here. Inventory is gonna go in at the inventory historical cost. Property plant equipment is gonna go in at the property plant equipment historical cost, which was all the way up here. And this will be our total assets. And notice how this one is not, all the same, if you compare it to this one. They're all the same. This one, they're all over the place. All right, coming down here, liabilities will go in at the current rate, year-end rate. That's the right one. Aha. So sorry. Okay. All right, common stock, we have to go all the way up over here. That. Did I use that on the last one? Now I'm doubting myself again. I don't think I used that on the last one. Oh, I gotta fix that. All right, 208, doggone it. I think I used this, I used the wrong one, I think on that. I'll fix it in a second. All right, so that would be these two. This will be the ending retained earnings. Which would be the same as this. All right, so this would come out to I recheck this to make sure I did this right. All right, so the difference between these is we have this much in assets and we owe 982, so this is going to be a gain of 32,710. Yep. And yeah, so this will be down to zero. So this is what we have, and this would just be, we gained 32,000 this year. It'll just be, pennies from heaven, and that would be it. It would be, you'd have no more, you wouldn't go year to year and have the translation loss or gain and all that kind of stuff. It's one and done. Whatever the gain and losses goes on the income statement and then it's over. I gotta look at this one. I know I did this one wrong. I sure did. I got this one really wrong. You guys, I'm old and senile. You guys have got to keep track of me. All right, so this is the 208 is what we need for that one.
I have 208 for mine there, so I don't know what happened.
I did something stupid. I know exactly what happened. Oh, I'm glad you did. Yeah, well, so this will be off. Now I gotta change all this. Let me see here. I gotta take out the translation adjustment of this. This is the right number, 131. I do remember that. This will be 131, 710. Wow, yeah, I'm glad you did. Yeah. And there's something to be said about, well, mine's right. So, I don't know, like pray for him or something. So this one, the loss would be, and we would actually have an additional loss of 46,000 on the comprehensive income. 46,000. It'd be additional loss. Now, this is not a comprehensive income statement. This is a plain old income statement. But yeah, I mean, we actually didn't lose 131 in this year. We actually built on our loss from last year of 85,000. This was a loss in the current year. And again, this doesn't get closed out. It just keeps going on, up and down, back and forth, whatever. It just stays all happening within the equity section. It never hits the income. It never hits the income unless you try to bring the dollars back in and you start using the temporal method. All right. Oh, that could have been better. Sorry about that, guys. Goofed up that. I goofed up the easy one. The easy one I goofed up. All right. All right. Well, so here's what I'll do. Oh, we're done. Oh, we're way early. Yay. See, I goofed up, but look at all this extra time. See that my speedy, air-filled presentation saved a lot of time. So we got, so what I'm going to do is I'll send out the, let's see, do I still have it up? Maybe. So I will email out the chapter 10 exam by tomorrow, maybe tonight, but certainly by tomorrow, I'll have it mailed out, and it'll be due on in 2 weeks from Friday. Next week, no class. Oh, let's put that up. Next week, no class, and week 8. 3/11 is for tutoring. Tutoring or whatever you want to, anything else. We're not, and no new material. Yeah, the term ends in 3 days, so we're not gonna cover any more, any new material. So week 8 is for tutoring. If you have anything, if you need to get stuff in, that's the time to do it. All right, any questions?
No questions?
Great having you guys, and I will get those exams out as soon as I can. Probably tomorrow. I'll see if I can get them out tonight. I'd like to get them out tonight because of, that stupid eye injection thing tomorrow. So I'll try to get them out tonight, but if I can, it'll be certainly by tomorrow.
Okay, thank you, Professor.
And have a good break.
Okay, have a good break. Good luck again on your surgery.
Thanks.
All right.
You're welcome. Bye-bye.
All right. Bye, everyone.
Take care.
Bye-bye.
Thank you. Bye-bye.